Welcome to the second part of the tutorial on company introduction and issue of share. We can see the share capital has a subdivision or subcategory. We can see the first category is authorized capital or nominal capital. Authorized capital is the capital that is authorized by the Securities and Exchange Commission. This is the maximum amount of capital you can raise from the capital market. That means this is the amount of capital for which you have taken permission from the Securities and Exchange Commission to raise the capital from the capital market. Out of this authorized capital, maybe you are issuing a part of the authorized capital. The issued capital indicates the part of capital that is issued to the public for subscription. And out of your issuing share, there may be a subscription or application from the interested investors, and the amount of capital that is subscribed by the investors or members or shareholders is known as subscribed capital. And if you issue the share in an installment, and out of those installment, the paid up capital is the amount of capital that already have been paid by the shareholders out of the total installment. Suppose a company has a share with the value of 10 per unit, and if you issue the share for the first installment with the amount of 2, then if you receive the first installment, then the paid amount is known as paid up share capital. And suppose you have not called the rest of the 8 out of 10, that is known as uncalled capital. That means the uncalled capital is the part of subscribed capital what has not been called up by the board of directors. Suppose you have taken permission for 5 billion as a capital, but if you issue 3 billion share, then the rest of the 2 billion share is known as reserve capital. That means the reserve capital represents the portion of the share capital which has not been already called up, because this is the part of uncalled capital out of the total authorized capital, that is known as reserve capital. Since there are several subdivision or subcategory of share capital, that is why we need to disclose the detailed information of the share capital in the notes of financial statements or notes to share capital account. We can see in the notes of financial statements, we have to disclose the detailed information about share capital. Initially, we have to show the number and amount of shares that is authorized by the Securities and Exchange Commission. Then you have to mention the number of shares issued, subscribed and fully paid, and subscribed but not fully paid. And you have to also mention the par value or face value of each share. As well as you have to show the reconciliation of the number of shares outstanding at the beginning and at the end of the accounting period or reporting period. As well as you have to show the rights share, preference share and restricted share. Then you can also disclose the shares in respect of each class in the company held by the holding company as well as the subsidiary company. And you have to also mention those shareholders who have shareholding more than 5% of the total capital. That means the shares in the company held by each shareholder holding more than 5% of share should be disclosed in the notes. As well as you have to disclose the share that is reserved for options or contract. And for the period of 5 years immediately preceding the date as at which the balance sheet or statement of financial position is prepared, you have to show the aggregate number and class of share allotted as fully paid up pursuant to contracts without payment being received in cash. You have to also mention the aggregate number and class of shares allotted as fully paid up by way of bonus share. You have to also show the aggregate number and class of shares brought back. As well as you have to show if there is any share that is convertible to equity share or preference share. I mean, if the equity share is convertible to preference share, or if the preference share is convertible to equity share, if there is any such conditions or agreement, that should be also mentioned in the disclosure of share capital in the notes to financial statements or notes to share capital. We can also disclose the calls unpaid. That means you have to show aggregate value of calls unpaid by directors and officers. And if there is any forfeited shares that is already paid by some shareholders but they failed to provide the full amount of par value, then you can also disclose those types of information. So these are the issues you can disclose in the notes to the share capital in the notes to the financial statement. You can see this is the format by which you can represent the detailed of share capital in the notes to share capital. You can see in the initial stage you can show the authorized capital. Authorized is the permitted capital by the Securities and Exchange Commission. That is the maximum amount of capital you can raise from the public. And while showing the authorized capital, you can disclose what are the categories of share, number of equity share and par value, number of preference share and their par value. You have to disclose the issued capital in the form of equity or preference share. Then you have to represent the subscribed capital, and there may be two types of subscribed capital. Out of total subscribed capital, there may be fully paid portion, there may be not fully paid portion. We have to disclose the information in details. As well as you have to deduct the calls-in-arrea. If there is any calls-in-arrea, you have to deduct it. And if there is any forfeited share, you can also add with the subscribed capital. By this format, you can represent the subcategory or subdivision of share capital in the notes to financial statement as a notes to share capital. Here is an illustration or example by which you can get a practical idea how to disclose the subcategory or subdivision of share capital. Suppose you can see the authorized capital of ABC Limited is 20 lakh, that is divided into 2 lakh equity shares of taka 10 each. That means total capital is 20 lakh, that is divided into 2 lakh equity share, and the value of each unit is 10. Suppose out of this 2 lakh equity share, the company is going to issue 1 lakh equity share of taka 10 each. And out of this 10, on the application, you are going to receive 2. On the allotment, you are going to receive taka 5. And on the final call, you have an intention to receive taka 3. And although the company has issued 1 lakh equity share, but the public applied for 90,000 equity shares. That means this is the subscribed capital. Although you are issuing 1 lakh equity share, but the public is applying for 90,000 equity share, that is called subscribed capital. And we can see all the monies was duly received. We are going to learn how to show this information in the balance sheet as well as how to show the detailed information of the share capital in the notes to accounts or notes to financial statements. We can see in the balance sheet we are showing the share capital 9 lakh. This 9 lakh is represented here, but in the notes we can see there is a indication of notes 1. We can see the note is showing that the company has authorized capital is 20 lakh. We can see 2 lakh equity share at the rate of 10 each, that is 20 lakh. And out of this 20 lakh, the company issued 1 lakh equity share at the rate of 10. That means the issued capital is 10 lakh. These two amounts are closed because just you are representing the amount of authorized and issued. They are not the amount which should be considered as capital. That's why you are closing this amount. But this is the amount 9 lakh. That is the actual capital company has raised from the public. You can see out of this 1 lakh equity share, 90,000 equity shares are subscribed by the investors. Each unit of share has a value of taka 10 each. That's why the subscribed capital is 9 lakh. In this way, you can represent the subdivision or subcategory of share capital in the notes as well as the total amount of share capital is disclosed in the balance sheet in this way. The balance sheet is also known as statement of financial position. You can see a company can issue share to the public or by private placement or in the form of rights issue or bonus issue. Whenever you are issuing the share to the public, there are three types of form. One is initial public offering and the second one is further public offering. The third category is offer for sale. Here we can see there are two terminologies on the issue of share. We can see depository system and dematerialization. In the initial stage of capital market, the company usually issued share certificate to the investor. But this share certificate has a weakness because the certificate can be copied or maybe the certificate is distorted or there may be any other risk. To avoid this risk of certificate of share, there is a system of depository system. By this system, the Central Depository Authority maintains all the information of purchasing and selling of shares by the investors. That means in the depository system, the authority maintains the electronic accounts. That means this is one kind of digital system by which the Central Depository System maintains the information of all shares who are purchasing, who are selling the shares. All the information are maintained by the depository system. And there is a similar terminology. Here we can see dematerialization. Whenever you are converting your physical share certificate into a digital or electronic form, that is known as dematerialization. And for participating in a depository system, you have to have a account. That means you have to open an account under the system of depository participant. Suppose you have a physical certificate of share, and if you want to convert this physical certificate into digital form or electronic form, you have to open a account for the purpose of dematerializing your share into digital form. For that purpose, you have to open an account. There is a similarity of opening bank account and account in the depository participant. In this perspective, the investor has to surrender the share certificate to the depository participant, and the depository participant will verify this certificate to the company, and if the information is okay, then you will get the number of shares in your digital form or electronic form under the account of Central Depository Authority. But nowadays, most of the shares are dematerialized share. because in the earlier years there was a share certificate, and those certificates were converted into dematerialized form, I mean digital form. But nowadays most of the issue are introduced in the share market as a digital form or electronic form. Whenever a company is issuing share, the pricing can be two types. The first one is fixed price offer method, and the another one is book building method. In the fixed price method, the company fixes a issue price that is advertised to the public by issuing the prospectus. If the price is high, then there will be a fewer number of subscription from the potential shareholders. But if the price is low, then there will be a huge number of application from the potential investors. For issuing the fixed price share, the company can follow the following steps. We can see in the initial stage, the company should select a merchant banker as a underwriter. This merchant banker will get a commission for processing the collection of application money from the potential investors, and as well as the company should issue a prospectus. Prospectus is one kind of advertisement where you have to mention the purpose of raising capital and the amount of capital and the time of receiving application and the time of closing the application. After disclosing the prospectus and after selecting the merchant banker will initiate the process. After that, you can receive the application from the shareholders. After receiving the application, you can allot the share to the applicants and you can issue the certificates. On the other hand, the book building method does not fix the predetermined price. That means in a book building method, the price of the share is not fixed by the company. The price is determined by the highest bid price that is demanded by the institutional investors. That means in case of book building method, you can arrange a roadshow in which the potential institutional investors can bid their maximum price. That means in a book building system, a process are taken to elicit demand, and then from the elicited demand, you can assess the price based on the highest bid from the potential investors. All the applications received from the institutional investors are arranged and a final offer price is determined, that is known as cutoff price. Generally, the cutoff price is the maximum amount of demand that is a part of bid price, and whenever you are selecting the cutoff price, you have to consider all the bidding price from the potential institutional investors. That means in a book building method, the underwriter or the merchant banker tries to determine the price based on the demand from the institutional investors. Their share price can be collected by installments. Whenever there is a fixed price share, you can collect the value of each unit in an installment process. And you can collect the price of the share in par value or face value or in premium price. Whatever be the situation, whenever you are issuing the shares in a installment process, then there are various stages in share accounting. We can see you have to collect the application money in the initial stage, then you have to allot the shares, then you have to receive the allotment money, then you have to invite for the second call or third call or final call, then you have to receive share call money. So whenever you are issuing share in installment, then these are the stages. We can see application, allotment, second call or final call, etc. So this is the second part of this tutorial. In the third part, we are going to learn the process of journalizing or process of accounting entries for the issue of share. Thank you.